The Fed pause is here, and they have just admitted defeat in their fight against inflation. This will have impacts on your investing in the markets for years to come. This is a long-term chart of the federal funds rate, and you can see for about 40 years, the Federal Reserve was consistently able to lower rates, even though there were times where rates rose. The long-term trend was down, but you can't go much lower than zero, especially when inflation breaks out from trillions of dollars of money printing. And so starting in 2022, they began to raise interest rates in an effort to fight inflation. Near the end of 2023, the Federal Reserve thought that they had done enough to stop inflation, and so they stopped raising rates. Towards the end of 2024, they started taking victory laps by cutting rates preemptively, thinking inflation was going to be completely gone soon. But as of today, the rate cuts are officially on pause. And all we have to do is take a look at one little change in the statement to see why they paused. Here you can see the transcript of the latest FOMC statement, with the red letters being the new words that were just added in this time, and the crossed out lines being the ones that they included last time and have eliminated now. You can see the last sentence of the first paragraph used to state that inflation has made progress toward the committee's 2% objective, but it remains somewhat elevated. This time, though, they eliminated a big chunk of that sentence, and you can see the words that were crossed out are has made progress toward the committee's 2% objective, which means this time the only thing that it said was inflation remains somewhat elevated. Essentially, the Federal Reserve has recognized that inflation is no longer making progress towards their goal of 2%, which is in and of itself too high, but that is for a video for another time. This is why they stopped cutting rates, because they cannot risk fueling inflation, even though they likely already have from their prior rate cuts. And I say that because it looks like they are repeating the exact same mistakes that they made during the 70s. You can see during the 70s, they cut rates, and when inflation roared back, they had to scramble and raise rates quickly again to try and get in front of it. And when they thought they got in front of inflation, they cut rates back down. It didn't work, so they had to raise rates back up again. And they were in a pattern for over a decade of raising rates to fight inflation, lowering rates prematurely, and going back and doing it again until finally they beat inflation in the early 80s, when of course they changed how the CPI was measured. But that's beside the point. If you want a better look at how we are following the exact same playbook, you can see this chart, which I'm sure you've seen a version of this chart all over social media, but it plots the current interest rate path by the Fed and overlays it on the path from the 70s. Now, the only thing different here is that the y-axes are different. Obviously, interest rates are not as high as they were back then, but even though the magnitude of interest rate changes is different between today and the 70s, the overall direction is the same. And most importantly, the overall direction of inflation looks to be the same as well, driven largely by fiscal policy. Fiscal policy is the government, not the Fed. If you look at how much money the US government took in taxes during the year of 2024, it was right around $4.9 trillion. Now, just for reference, if the US government were to spend the exact same amount of money that they spent in 2019 on the entire federal budget, we would be running a surplus right now. But instead, the US government ran a $2 trillion deficit, which means even though the government is taxing enough to run a surplus, if all they did was spend the already insane amount that they used to spend in every year prior to 2020 for the entire nation's history, they're spending $2 trillion more than that, which they're covering through borrowing. This is why long-term interest rates have continued to be on the rise, despite the fact that recently the Federal Reserve has cut rates, because the market largely understands that there is no way to slow this fiscal train down. The things that the government spends money on are not easily able to be cut significantly enough to make a difference on the deficit and the national debt. Because even if the new Trump administration is able to significantly slash spending in a lot of discretionary areas of the government spending, they're also planning on cutting taxes too, which means the deficit will probably not meaningfully change. Now, here's the kicker. Because the government has to continue to borrow $1 to $2 trillion every year just to cover its spending, it sucks that liquidity out of the markets. There's a crowding out effect. This means that the cash in the system, the liquidity, is slowly being drained, just like it was going into 2019. And so while the Federal Reserve decided to maintain the amount of money that they are letting bleed off of their balance sheet at $25 billion per month, in other words, they are continuing forward with quantitative tightening for now, at a certain point, they will have to stop quantitative tightening very soon. It'll probably happen this year, and even reverse course into quantitative easing. Otherwise, you end up with the exact same situation that you had in 2019 and before the financial crisis started, where the banks don't have cash. They don't have the liquidity, and the entire financial system is at risk of imploding overnight. This is a situation called fiscal dominance, in which everything the US government does drives everything else. Monetary policy serves the government, not the other way around. This means two things. Short term, we are very likely to see continued volatility in the stock market. I've been warning you guys about volatility in the stock market for a couple of months now, and if you look back on what the S&P 500 has done over the last couple of months, it has indeed been extremely volatile. I still think the overall trend will continue higher because ultimately what we are seeing is an inflationary deleveraging, which means the government borrows insane amounts of money. It can't come from the existing money supply. Therefore, it has to be printed into existence through things like the Federal Reserve holding the Fed funds rate super low, quantitative easing, banks lending money into existence, different deregulation on the banks to allow them to print money, more money in order to loan it to the government. This would be a change in banking regulations that would allow banks to consider treasuries as reserves. But in any case, this is an inflationary deleveraging because the government borrows money into existence that wasn't there before and spends that, driving prices up, driving long-term rates up, even though they themselves are able to deleverage because they get lower interest rates or a lower cost of service on their debt by inflating it away. In other words, the long-term deterioration of the currency will continue, driving prices of assets and goods and services higher, with lots of volatility along the way and more expensive interest rates on regular debt for individuals like you and I. Fed themselves reiterated this, saying that policy is meaningfully restrictive, saying that interest rates are meaningfully above the so-called neutral rate. Just so you guys know, the neutral rate, according to Fed policy speak, versus the natural rate, they're different things. The neutral rate would be a mythical interest rate in which the interest rate that the Fed chooses is not stimulative to economic growth and it is not restrictive to economic growth. In other words, they imagine there's some Goldilocks zone at which they can hold the federal funds rate that will not influence the economy either way for growth or for pulling back on prices. This is different than what I've talked about many times on this channel, which is the natural rate. The natural rate is what would interest rates be if there were no force being exerted artificially on the market. The natural rate is what the interest rate would be if it were not being manipulated artificially or set artificially by an external force that has a monopoly on setting interest rates. In a hypothetical example of a free market economy, if I have a bunch of cash in a savings account, you have a bunch of cash in a savings account, and everybody does, well, the savings pool then is very large, which means everybody who has money already saved is going to be competing for the few people who are borrowers. That means interest rates are going to be competitively driven down from all of the savers. We're going to say, hey, I want to lend you money at 3%, or I want to lend you money at 2% because we want that business. So when the savings pool is large, interest rates will naturally go down, and that will incentivize spending and borrowing. That will create some growth. But once the pendulum swings too far the other way and everybody has spent and everybody has borrowed, the savings pool has been drained, which means now the borrowers are competing for the few savers to lend to them. All the borrowers are saying, I'll borrow at 8%, I'll borrow at 9%, I'll borrow at 10%. And the few people who still have savings get to take advantage of that. This natural pendulum swing will now start incentivizing people to save so that they can take advantage of the higher rates instead of paying them. So it will rebuild the savings pool. So in a completely free market, the natural rate is always changing and it is always influencing behavior, whether that is to save or spend, and it's always measured against all the other possibilities somebody could do with their money. Anytime you have a third party, another entity come in and through force say, I declare this is what the interest rate will be, by definition, it will be wrong. It will be something other than the natural interest rate. Therefore, whatever interest rate the Federal Reserve sets, it will always be either artificially stimulating more growth than there should be, in other words, causing more spending than there should be, or it will be artificially suppressing that growth. Whether interest rates are at the Fed's mythical neutral rate or not, it will always cause malinvestment. It will always cause a misallocation of resources, and it will always cause either too little growth or too much. There's a lot of talks about ending the federal income tax and deportations and deregulation and firing a bunch of people. And some of that will have some good outcomes for our nation. But if you really wanted to make the economy strong and really wanted to make this country be able to thrive, you can't get a bigger bang for your buck than simply eliminating the Federal Reserve. It is unnecessary, unneeded, and a tumor on our nation's economy that must be removed and not replaced. As always, thank you so much for watching. Have a great day.